Hey there, and welcome to my channel, the Paper Bag Investor. Today's video, I want to talk about Lemonade's Q4 2020 earnings and discuss it in a little more detail now that we've had the earnings call. I'm going to talk about a red flag that I brought up yesterday and the answer we got in the earnings call from Daniel Schreiber himself. I want to talk about some of my surprise at the sell-off. The stock was down about 16%. Big sell-off today, and again, kind of reemphasize how I think the stock is a little bit misunderstood. And then finally, I want to highlight something that Daniel Schreiber said in the earnings call and just talk about that a little bit. So let's get into it. Before I go any further, though, I just want to make it absolutely clear, not a personal financial advisor, just a guy with a paper bag on his head who loves investing and thinking about the future. If you love investing, you love thinking about the future, and you get value out of this video, I encourage you to hit that subscribe button down below, and you might get value out of my future videos as well. So I encourage you to do that. So let's get into it. We'll dive right in. Okay, so I want to talk about the red flag and the answer we got. This is from my video yesterday, and I tweeted after reading the earnings letter, tweeted this out to Daniel Schreiber, the CEO of Lemonade, said, "Hey, Daniel Schreiber, in the Lemonade's call tomorrow, can we touch on why customer growth was only 6% quarter over quarter for 59,489 new customers, the lowest customer gain since Q3 2018. This is my main concern from the letter." When I was reading through the letter, this kind of jumped out at me, and I thought, well, if the customer, is there something wrong that the amount of customers actually growing is decreasing? Because I know their whole strategy, Lemonade, is to, right now in this phase, is to grow as fast and aggressively as possible. So I was pretty concerned about that, but he actually answered this in the call. So let's take a listen to that. Just be a couple minutes here as he kind of details his answer. So let's take a listen.
I want to interject with another point which is tangential to your question, and we got some questions over social media today from the Paperback Investor and others about the fact that while we saw very robust growth in Q4, we didn't see the same proportion of growth in our customer count. And I thought this was a good place just to address that. So you're right. We don't break down the customers by product. I just want to make the broader point, which is we don't guide for customer count in general. So what we are optimizing for is growth and profitability of our entire book of business. The top line metric that we use is in-force premium, which is really multiplication of how many customers we have times premium per customer. And what our machines are optimizing for is the output of that multiplication. So if we were just optimizing for customer count, we would just sell renters all day long. If we were just optimizing for premium per customer, we would only sell homeowners all day long. It's really the multiplication of the two which produces the best return on investment. And the more markets we have, the more products we have, the more able we are to play the arbitrage of seeing where can we get the best return on the dollar invested. And we kind of love all our children, all our geographies, all our products equally, but the way we allocate dollars to them is based on that formula, so that the machines are constantly looking to optimize for that. And the outcome of that is that in Q4 that we're reporting on now, Q4 2020, we actually spent fewer dollars on marketing than we did during the Q4 of 2019, even though we sold a lot more. In fact, we mentioned this in the letter that our efficiencies increased 88% 2020 versus 2019, and that's really how. It's by solving for how do we get the most bang for the buck, and what we're optimizing for is growth of our business in dollar terms and not in policy count or in customer count, which is why that's also what we guide for. So just get that in there. Thanks.
So that was pretty cool that he actually saw my tweet and replied to my tweet. I was very impressed with that. I want to give you my reaction to his answer. Kind of broke this down. I think his answer made a lot of sense. Basically, they optimize for growth of the in-force premium and the gross earned premium. Of course, they want a overall healthy gross loss ratio, but not necessarily the number of customers. And I think that made sense. I was very happy, very satisfied with their answer. I would love to understand and see more detail exactly how they model and optimize for this growth around different customer parameters. How do they know and model and refine that model to say that this guy is who we should target and advertise and really try and gain as a new customer because they're going to have over a long span of time. We feel that they're going to be a great, excellent customer to have and not bother with the other person who's just going to have renter's insurance for a little bit and then stop. I'm a huge nerd, so I'd love to see how the details of that, but I trust that their models are working, and that's exciting to see that these are the things they're thinking about. I just want to mention, I'm going to redo my own model for Lemonade, kind of a 5-year outlook, and center it more around their gross earned premium growth rate and and their in-force premium and how that could look and affect their valuation over time. So expect a future video on that. But overall, I'm really impressed that the CEO of a company like Lemonade, he actually took the time and attention to see an answer of a random guy with a paper bag on his head, wrote to him on Twitter, and he actually was able to weave in an answer, a very good answer, into also answering one of the analysts' questions, but also answering my question as well. So really cool to see that he's that attentive to the investors out there. So now let's talk about what I'm calling surprise at the sell-off and what it shows. So the stock fell about 16% today, and that surprised me a bit, but I think just shows how misunderstood this company really is. I think the price fell mostly on lower revenues and revenue expectations, but I'm going to explain. I think this is short-sighted with Lemonade, with this company. So the revenue from year over year fourth quarter was $20.5 million, actually down from the year prior. And their guidance for the next year, again, I think this is why the stock fell, was, this next quarter around $22 million. So kind of in line with where they were, not much different. And they're also looking out for the whole 2021. It's not too much different if you multiply, 22.5 by 4. Here, they're not expecting massive growth in this area. And I think a lot of people just kind of look at that headline and say, wow, how does this make any sense? A $6 billion company and they make $20 million in revenue in the quarter. Like, how does this make any sense whatsoever? But I think it makes sense, especially if you look back at the bigger picture, okay? And they actually said this in their letter, and I mentioned this in my last video, but their fourth quarter, they say fourth quarter total revenue was $20.5 million. Note that our proportional reinsurance agreement went into effect at the beginning of the third quarter, increasing the proportion of premium that is ceded to 75%. This meaningfully improves the capital efficiency of our business, but can make year-on-year comparisons of revenue misleading. And again, I think, Lemonade's whole strategy is they want to grow as fast as possible geographically all over the world, and they want to grow in their product lineup. So they want to keep adding new products and then adding those products across geographies. So now, as an insurance company, if you just scaled that aggressively and had new products, that'd be very, very risky, because if something went wrong, say there was something wrong with your model and there's some kind of catastrophe and maybe it wasn't modeled as well as it should have been, that's a big deal, and that could be catastrophic for your company. Could even cause bankruptcy. So what they're doing is they're using reinsurance, which means a large portion of the money they are bringing in is actually going to another, kind of reinsuring themselves against their own models, so that they can limit the amount of damage that could be done if there was a catastrophe or something went wrong. This is a really, really smart approach, in my opinion, and really smart way to grow aggressively. And as a digital kind of insurer, they have the ability to, and they want to grow rapidly and aggressively. And they think their kind of ethos as a company and what they're offering could really appeal universally across the world. And I think they're right on that. So I'm still learning about their reinsurance in detail, and I plan to do a future video on that. So if you are interested in that, make sure you subscribe, but you can look for that going forward. I will have that. But yeah, that's in a nutshell, I think, why the market is kind of misreading this. I think that's why it went down, but I think people are misunderstanding. Rather than just looking at revenue, you should be looking at gross earned premium. And somebody, I think, asked me this in one of my comments I saw in my last video, is they're asking what gross earned premium was. That's basically their in-force premium multiplied by the difference of the leftovers of their gross loss ratio. So say they have, their gross loss ratio of 70%. It means 70% of the money you're bringing in, insurance policies, gets paid back to those insurers or to those customers that need claims, and then the 30% is your gross earned premium. That's an amount. So if this keeps growing, at this kind of a rate, that's excellent, and that's really what you want to watch is your overall in-force premiums. This gross earned premium could fluctuate because your gross loss ratio could fluctuate. They talked about in the earnings call the winter freeze in Texas and how that's going to affect their Q1, but overall their in-force premiums is maybe even better metric you want to be watching along with this one. So that's really interesting, and something to really understand with this company. And you'll expect that future video. But what does this mean for the stock? I want to just touch on this. I'm not a short-term trader. I'm a really long-term investor thinker, but I do speculate, and I wonder if the stock price could fluctuate within a range for some time. Sometime, I don't know, could be a year, 2, 3 years, even 4 or 5 years, possibly. I don't know. I wonder if it could fluctuate in some kind of a range because of this misunderstanding from the market. Lemonade's still in the early stage of growing geographically and growing product line, and I think as they mature and they grow, they put down roots, and then eventually we'll see the fruit of their labor. And I think when we see their fruit, they will show up because their global footprint and product lineup will expand. That's going to expand. Then they're going to have more confidence in their underwriting models as they have more time and they just more experience refining those models. And then as that happens, their reinsurance will become less and less important, and they will use it less. And I think use it less on different products and different products and different geographies. And then that's when you're going to really see the actual revenue of the company take off and the actual income of the company taking off. But I'm not sure. I wonder, I speculate if the stock could trade within kind of a range up to that point. And I want to highlight one more thing from Daniel Schreiber in the earnings call and just sort of leave you with that. So let's take a look at this quick clip that I'll play for you.
The main thrust of the passage that you're referring to is we are very long-term in our thinking. We want to build a huge company over time and be extremely profitable. And we think that we are today in a window of opportunity to create really a generational company, which is what we're very focused on.
So that's really exciting for me to hear the CEO, Daniel Schreiber, just say that, just talk about that their overall long-term vision for this company, that they're not interested in just trying to maximize revenues or maximize income right now, but actually trying to think in the most strategic best way possible for a digital sort of 21st century insurance company, and think long term with that and act on that long term plan. So that's really exciting for me. Also really exciting as Lemonade investor to see to see that sort of global ambition that they're calling themselves. They want to be a generational company. That's their aspiration. That's amazing to see that kind of ambition and just speaking that language. That's what their goal is, to be a generational, to be like sort of, think Google for search, you think Facebook for the main, the social media network, you want to think insurance, you want to think Lemonade for insurance. To me, that's really exciting as an investor, and I'll leave you guys with that. If you got value out of this video, I encourage you to hit that subscribe button, share it with somebody else, hit the thumbs up, helps the YouTube algorithm, and thank you for watching. I will see you in my next video. And remember, it's in the bag. Cheers.